Hello, this is Barney with Russell Real Estate, and today I wanted to go over an email from a loan officer I received, and yeah, just wanted to kind of go over the brief talking points for this. It's the first week in February, actually second week in February right now, February 9th, and basically what she says here is that the Federal Housing Finance Agency said that they're going to be making some changes with the loan level pricing adjustment fees. And some of these will be significant depending on what type of borrower you are. So it's not going to affect any FHA borrowers, USDA, or VA loan products. So those are government backed loan products. For Fannie Mae and Freddie Mac, basically what they're talking about as far as the changes here are going to be to conventional or conforming mortgages. And I'm not a loan officer, so I'm not going to go into too much detail with this. I just want it to be on your radar if you're looking to buy a home in the near future and you're planning on using a conventional loan. There are a ton of different loan products out there. You need to work with a loan officer that you trust is basically performing the best or in your best interest, I should say. So some of the things that are going to affect your pricing as far as interest rate is concerned is going to be your credit score, the loan features, the loan to value. So basically loan to value, that's like when you say you're putting 20% down for your down payment. Well, you have an 80% loan to value then. So 80% LTV, that's how much you're taking out for your loan compared to the value of the home. So they have different ratios for what they're looking for. So basically, they base it off credit score here on the left-hand column. And then when you're looking over here at all of these columns, you're going to actually be looking at the percentage down payment. So it is kind of interesting that in some scenarios, it actually makes more sense or it's not advantageous to you as far as how much you're paying for the loan to not put as much money down. So for example, let's just take a look here. Here's a good example. So say your credit score is between 680 and 699. As far as the cost of the loan here, it looks like it's going to be 1.75% if you're between 75 and 80% LTV. It's going to jump up, which you would think, okay, yeah, it jumps up if you borrow more because it's going to be more of a potential risk for the bank or for the lender. But then you see as you start going back and you're basically borrowing even more money. So a 10 to 15% down payment, a 5 to 10% down payment, or less than 5% for your down payment, you actually see that number starts going back down again. And part of this, in my opinion, is to help out those first-time home buyers or people with they're basically just starting out. Maybe they don't have as much money saved up. Maybe they are affected with their credit score, different things like that, where the bank is still protected, and it's because they're actually charging more for more credit worthy or safer bets, I should say, within reason, like within this 75 to 85% down payment. But that's allowing new people to get into home ownership because that really is going to help you create a lot of wealth over time. So that's basically one thing that we're looking at. The other thing that they do say that they're going to be changing is debt to income ratios are also now a major contributing factor with new pricing adjustment for borrowers with a debt to income ratio or DTI ratio above 40%. So basically, if your debt to income ratio is above 40%, you should, in theory, be paying more. The bank or the lender should be compensated by giving you a loan because you are going to be more at risk to default on that loan. And that's just saying because you have so much debt, whether it's credit card debt, medical bills, student loans, car payments, different things like that, or obviously including your house payment there too. If anything happens, because your debt is such a high percentage compared to the income that you make, if anything happens, you could have 2 bad months in a row and suddenly you're behind on your mortgage payment and you're at risk of defaulting on your mortgage payment. So, this is their way of kind of protecting themselves a little more, where essentially, if you're not putting down more than 25% for your down payment, you're going to be charged an extra amount. If you can put down 25 to 30%, or actually, I should say 25 to 40%, you'll get charged less. And then if it's anything over 40%, really, you're not a risk to them at that point, even with a higher debt to income ratio. So they don't really charge as much. So, again, these are just talking points. I'm not a loan officer. I always try to refer people out to strong loan officers that can help educate as well, because truly I want you to feel comfortable with whoever you're going to be working with. And then last thing that I did want to go over here was just her recap here. Basically, she says the middle of the road borrower is also going to be hit with higher fees from Fannie Mae and Freddie Mac, with the Federal Housing Finance Administration creating new bans for borrowers at the highest tiers. Borrowers with FICO scores between 720 and 760 essentially will pay more in those fees. So fees are raised on some borrowers with good credit scores and moderate down payments, hitting middle wealth home buyers. So again, for whatever reason, Federal Housing Finance Administration or agency decided to change the structure for these fees, and it doesn't make sense for the premium home buyer, as far as like, hey, they are putting a substantial down payment and they're an 800 credit score, they have low debt to income ratio. It doesn't make sense for banks or lenders to penalize those people, because they want to incentivize those people to buy more houses. That's how the bank makes money, and they can essentially guarantee that this is a safe borrower. They also do want to, this agency, they want to help people get into home ownership, because that is one of the best ways to pull yourself out from the lower bracket as far as net wealth percentages and everything like that. If you can go from being a renter to a homeowner over time, that does prove to be significant as far as adding to your net worth. So, unfortunately, somebody has to pay for this. And that somebody is going to be that middle of the road borrower who has good but not excellent credit, and unfortunately, they're going to pay a little more when it comes to buying houses if you're financing it and not paying all cash. So again, this is just kind of my 2 cents here. I don't want to, as Kelly puts it here, step into each other's lanes. This isn't what I do. I'm just kind of giving a general overview of what I'm seeing, what I'm thinking. I might be wrong, so if you do have any questions, either feel free to reach out to me. I'll point you in the right direction and connect you with a great loan officer. Or if you know that what I'm saying doesn't make any sense, then feel free to correct me. I'm always happy to learn and open to having positive conversations with other intelligent real estate professionals. Again, this is Caleb Barney with Russell Real Estate, and have a great day.